So it feels like the Iran conflict is dominating everything right now. And so let me start there. So oil prices are staying high because of the conflict. And even if the war ends, how quickly could prices come down? Of course, we don't know the result yet, but or are there factors that could keep them elevated for a while?
I think that we're sitting on a very interesting day. Even if the war were to end this week or in the next couple of weeks, there's been a lot of damage done that will take a while to cycle through the economy, particularly the economy of the Middle East and the MENA countries. Oil capacity has been diminished, so it will take a while for prices to come down. There are two factors in the price. One is the situation with less refining capacity and the infrastructure that's been destroyed. That might take years to come back. The second is the fear factor, because we don't know what's going to happen, and that impacts the price as well. If I may, I think an interesting question is, given the really rather terrible situation we're in, why have not the markets gone down much more than they have? And I think that the answer to that, if we talked earlier in the year, was that we were quite positive on the market, especially the US market, but even the global market. As you know, we've advised clients to invest more broadly than the Magnificent Seven, and for those, especially US clients, to invest outside the United States, including Korea. And that's been a very great return for them, even disrupted by this war. So it's those tail factors, the particularly massive investment in AI, tax incentives, refunds happening literally starting last week and this week, fiscal spending. There were a lot of tailwinds. So the market has not adjusted as much as we would have thought given this situation. So that's sort of how I would answer your question.
If in the energy market, this turns into a longer period of uncertainty, I think you already answered part of it, but with no clear resolution and ongoing small clashes, what would you say is the biggest hidden risk investors should watch?
So I think that investors might be looking too much at just the energy impact. Energy, if you have a long memory, was quite impactful on economies. Certainly all of the developed economies, including Korea, are much more energy efficient than they were in the past. So energy has a much, much, much less impact. But the slowdown in the Strait of Hormuz also impacts natural gas. It impacts, very importantly, fertilizer, which could pass through to agricultural and food prices. It affects helium, which is vital for semiconductors. And it impacts all of the food and everything else for those countries in the Middle East. And it creates general instability. So I think we have to be aware of all of those situations. What we think right now is that if you look at the risks of inflation or slowdown in growth, that the greatest risk right now is inflation. What the stock market, at least in the US, is telling us is that they're more concerned about inflation than they are about growth. So that's the risk. Clearly, the risk of growth or the risk of a recession has increased significantly. The global economy will not grow at the same rate we thought it would have at the beginning of the year. And so I think that's the risk. Now, there are very big tail risks. So I don't know what's going to happen tonight or even in the next 2 weeks. You and I were joking, but it's a little scary to do an interview like this because everything changes so fast. So there's a risk that something quite dramatic and negative could happen. That's a bigger risk than the risk that something wonderful happens and it all ends and everybody's happy. But it's the two tails. So the market is riskier than it was before.
I know we are not the fortune teller and we cannot expect exact number, but how do you see and how does Franklin Templeton expect the inflation end of this year?
Inflation is very tough to gauge, but we had hoped that in the US, inflation would drop a little bit this year and head from 3% down to closer to 2%. Now we think it'll be at least 3%, if not in a very bad situation, up to 4%. So it's interesting that now we are talking less about the Federal Reserve, which would have been the question on our interview if it had been a month or two ago, and more about the war in Iran. But the Federal Reserve is less likely to lower rates than it was before. And now, curiously, we even have the potential that the Federal Reserve would have to raise rates. If we get in that situation, it's stagflation. And there are many scenarios that aren't good, but that's a scenario that's not good.
So last FOMC, Jerome Powell also referred about labor market. So on the US labor market, we are hearing mixed views. Some say it's still strong, while others worry about a low hiring, low firing environment. So, how are you reading this? You already said it's kind of a stagflation, but is this more of a recession signal or a new kind of stability where people are staying in their job longer?
It's hard to tell what the signal is because the war has been so short. We don't really see it as positive or negative. The United States famously is a consumption country. About two-thirds of the economy is consumption. Now, the really huge change in the United States over the last 2 or 3 years has been the massive amount of investment in the data centers and AI. So investment has been a bigger part of the US than it has been historically. But the consumer is still the most important. So some of that passes through in the labor market. I think that at some level, we'd be in a recession if it weren't for all the AI spending. We're lucky, I guess, in that sense. But there are even some headwinds, including political headwinds with AI spending. As you know, some states in the US are thinking of banning new spending on AI.
There's great talk that the Fed may delay rate cuts, and you already know about that, of course. And how do you see the timing from here?
So we're still thinking there's probably one rate cut. That's not quite the right thing I should say. If you had talked to me 2 or 3 months ago, I would have said 2 rate cuts. Now I'm saying one. So we have changed our view. We're not at rate raises yet, but that's the situation.
Speaking of AI, the AI bubble debate seems to have faded a bit with the Iran issue. And how would you describe the current state of the AI trade? Some point to a gap between heavy investment and slower profit realization. So, does that concern you at this stage?
We came into the last year and a half saying that investors should move from the Magnificent Seven stocks to broader stocks, including smaller cap stocks and stocks outside of the United States. That's been a good trade for the last year and a half, partly because the worst performers have been the Mag 7, particularly Microsoft and Tesla. So those stocks are becoming relatively less expensive. We don't think it's quite a buy signal yet, but they're less expensive. We're still generally recommending very broad investing, but we're just about ready to say if you're not overweight in the Mag 7, it might be interesting to reinvest in them. Let me answer a little bit of a different question. At this point, the possibility of a recession has increased. We don't think there's going to be a recession, but the risk has increased. If there is a recession, what stocks do best? Generally, growth stocks. So if somebody listening to this thinks that we're likely to have a recession, it's probably a good time to move into those growth stocks. If somebody thinks that, which we do, that we're still not likely to have a recession in the next couple of years, it's better to be broader invested.
Could you recommend kind of specific sectors or industry?
I'll start with a little bit different question. How should investors invest right now? And then I'll answer your question about sectors. So we think that we have no idea what's going to happen with the war or with Iran or with oil prices. And no one else does either. But we know from looking historically, and if I'm trying to give a very strong message to the listeners here, this is a time to be disciplined rather than emotional. So, how do you be disciplined? We think one of the best ways to do that is to look at what the market's telling us, particularly from a risk perspective. And you do that looking at the VIX volatility index. So, if we are to look at the VIX index over the last 30 or 40 years, every time it's gotten above 30, in 1 year's time, the median return is 23%. So it's been a pretty good indicator of future returns. Whenever the VIX is above 50, the median return is around 30%, and that's been accurate 100% of the time. So for stock market investors right now, we are encouraging them to be very cautious and to dollar cost average or make little investments as the market falls, especially if volatility hits above 30, and to make a big decision to invest if the volatility gets above 50. But it will be ugly and it will be a very unpleasant time to make that decision. We think there's a lot of opportunity right now in the shorter duration of the fixed income market. So the 2 year and everything, yields have increased. There's a lot of opportunity there. That's a way to reduce your risk. Now, within the equity market, with the sectors, is that you asked about labor, and almost all the increase in labor right now is in the healthcare industry. As America ages and as people need more help, that is one of the areas. So healthcare industry. We're still quite positive on the financial sector, especially if interest rates come down. So that's the second sector we're looking at. Sad to say, but the defense sector in the US, and by the way, in Korea as well, is an area that is destined to grow pretty dramatically. And finally, and maybe somewhat controversially, we're still positive on industrials, which is basically value investing, because we don't think there's going to be a recession. But as I said, if there is, probably growth stocks will do better, and we'll make that call probably very quickly. That's what we're thinking for Americans. But remember, most Americans and probably many foreign investors, including in Korea, are a bit overweight the United States. So we've advised investing outside of the United States. That structure has changed a lot in the last month or so. We're still pretty positive on Japan and selectively on Europe, not because we think Europe is as strong an economy as the US, but because it's cheaper.
But some people think at current levels, this is kind of buying opportunity in the US market.
They do. But my answer to that would be I don't know. Let me be a little bit arrogant, but they don't know either. They're right. In terms of earnings are strong or increasing, and markets are down. So the risk reward level is better. So that may be an opportunity. And let's hope they're right. I hope they're right. But what we're suggesting right now is a little bit more disciplined approach. And that is to look at the volatility in the market, look at what's happened historically, and make decisions based on that. If we're wrong, then you get a 4 plus return in fixed income. If we're right, then you've avoided a downturn in equity and hopefully caught a big upturn.
Jamie Dimon and recently Warren Buffett also concerned about private credit markets. They're concerned around the private credit, but also some optimism that stronger players will stand out. How serious is the risk in your view?
This is a great question. And just to give a little historical context, private credit was really only started in a big way after the financial crisis in 2008, when the banks no longer gave credit and it became private. In 2008, the whole global economy was at risk of imploding because of the systemic risk, meaning if the banks failed, then the economy failed. So I think what Jamie Dimon was saying is that if private credit fails, it doesn't mean the whole economy comes down. So we would strongly agree with him that private credit does not have the systemic risk, meaning bringing down the global economy, that the bank risk had in 2008. So I think that there are three things going on with private credit. One is systemic risk. I don't think we have that. Secondly are the assets that are being invested in private credit funds, is there a risk there? Are they bad credits? Was too much credit given to bad companies when it was really lots of money going out in 2020? Of course, some of it was, but generally, we think overall the investments that private credit has made have been pretty solid, and the covenants have been pretty solid. So the underlying investment we're less worried about, with, of course, the big question being the software companies, which is a big percentage of the total investment. And there's some risk there. We don't think the software companies are going out of business, and we think the market reaction has been a little bit overreacted, but that's something to look at. The really big issue is the structure of private credit. It's illiquid. It's by definition, you can't sell it. And it's been sold to retail investors poorly. It has been not described very well. And somehow, many retail investors still have the idea, and maybe it's because you can get 5% back a year, that they can somehow liquidate their investment. So there's been a rush to the gates for liquidity that just isn't there. That is a structural issue with how private credit is structured for wealth investors. Now, the majority of private credit is with institutional investors, and they don't have that issue. So that's poor communication, and you'd want to be very careful as an individual investor how you think about private credit. One of the other issues, if I may say, is what's changed greatly since private credit has come in is the high yield market, sometimes called the junk market. That market, in essence, private credit took all, can I say this? Private credit took all the junk out of the junk market and is a higher risk market. The high yield market now is much higher quality than it used to be. It is shorter duration than it used to be. So less risky, both in terms of the companies invests in and as well as the duration. And very importantly, it's liquid. So you have to balance those two opportunities. And in many cases, we think it might make sense, particularly for the wealth investor, to invest in high yield rather than tie up too much in illiquidity in private credit.
Because of Iran conflict, many Koreans are suffered by strong dollar. So the $1 exchange rate is back to level we saw during the 2008 financial crisis. So the strong dollar is making overseas investing tougher for Korean investors. So how do you see the dollar trend from here? Could this level become something closer to a new normal?
Yes, the dollar has appreciated, and I appreciate that it's particularly done so relative to Korea, partly because of Korea's dependence on foreign energy resources. So Korea's hit worse than countries that have more energy independence. That said, it's not as bad as it has been in the past. So the dollar has not been as much of a safe haven or appreciated as much as it has in the past. We think that longer term, the dollar is likely to fall over the next 5 or 10 years, and that that's more likely than it was, more likely since this war than it was before in terms of structurally. The Iranians, for example, are trying to tax the traffic through the Strait of Hormuz, and payments would be in the Chinese yen. So the answer to your question is no, we don't think the dollar versus the yuan is likely to stay at the current level. So again, I'm speaking from America. So I would say from American perspective, that makes Korea cheaper, right? So it makes Korea a better investment. From a Korean perspective, it makes America more expensive, and so it makes it tougher to make that decision. So it very much depends where you sit as an investor.
Could you please introduce your view about S&P 500 end of this year?
We have had a target of between 7,000 and 7,400 and earnings growth around 10%. I'm literally meeting with all the CIOs of our company this afternoon. So again, this is Tuesday. And I expect that that will drop a little bit in terms of the expectation for growth. So we did interview all of our portfolio managers. That's just one of the things that I do. We have about 750 investment people. I chair the investment team, but to get the views of all of them, and just about 90% of them think the market is likely to be up by the end of the year. So they're still positive, which is in some levels remarkable given what's happened. If I may say, and go back in history, you and I could have been talking a year ago, right? In April, after tariffs, where everything looked terrible and there was a lot of fright. That's a time where the VIX did go above 30. It didn't hit 50, I don't think, and the market recovered dramatically. So it's those periods where you see a great opportunity.
Thank you so much for your time again, and I hope I can see you next time.
Well, as you know, I'm a big fan of Korea, a long-term investor in Korea. Franklin Templeton's been in Korea for a long time, so I know it's tough globally and tough for a lot of my friends and colleagues in Korea. So I wish you all the best.